Bankless Nation, I'm here with Karn Saroya. He is the founder and CEO at Re. Karn, welcome to the show.
Thanks for having me. Appreciate it.
And back on the podcast today, we're getting some extra help here. Avichal from Electric Capital, who is an investor in Re. Avichal, welcome back to the podcast.
Good to see you, man. Thanks for having us.
Karn, I'll just start you off with the easy layup. What is Re?
Yeah, we're an on-chain reinsurer. We take in stablecoins. Those stablecoins find their way to primarily U.S. insurance companies. That capital lets them write insurance business. They collect premiums, percolates all the way back to this on-chain capital layer. And that's what it is. We back 35 insurance carriers who have $500 million in business, and should grow to about $1 billion over the course of the next 7-ish months.
Cool. What do we need to know about reinsurance to be productive in this conversation? And why is a blockchain, why are smart contracts the right substrate to build the frontier of reinsurance?
Yeah. It's a massive, boring business. There's about $1 trillion in reinsurance premium that's processed annually across, dozens of very large reinsurers, Munich Re, Swiss Re, Lloyd's of London. All of it is basically just a pot of opaque capital. It's attested to kind of asynchronously. And the product that they sell is a promise. It's a promise to pay their insurance company customers if things happen. And then the second part of that is to prove that they can pay at a given moment's notice, right? And so being on-chain and utilizing on-chain capital is probably the most elegant use case of in my mind, on-chain capital, and that it fulfills both of those things. We take in capital that anyone in the world can see at any given point in time, regulators, insurance company customers, the insurers themselves, anyone with a computer can see that we are good for the promise and that we're solvent at any given moment in time. It's also a massive pool of capital that can take diversified risks, and the cash flows back into this pool of capital being transparent. Something that's never existed before in this space.
So what part of the capital stack around reinsurance is blockchain tech doing this on smart contracts? You're built on Ethereum using stablecoins. What part of that are you improving? Now, is this like are you guys simply improving the business model margins by using blockchains as your backend, or what's really the secret sauce? What's the X factor here?
Yeah, so in two parts. If you think about reinsurance as a product, it's another capital source for insurance companies. The first part is the manufacture of the product of reinsurance. The expense ratio is lower. We're a much higher operating leverage business. We have less than a dozen employees. We'll be on track to be a multi-billion-dollar insurance market. In comparison to legacy reinsurers that have tens of thousands of employees, legacy business, legacy infrastructure, that's a meaningful difference in just the expense ratio load. And we're the first to find scale with on-chain capital and build transformers into all DeFi protocols that now use us or we're composable with to pull in capital in a way that hasn't been done before in this space. And our viewpoint is at scale, as we kind of proliferate through those borderland markets, as folks are using our products on Pendle and the like, that we have a cost of capital is competitive, if not superior, to practically every reinsurer in the world. And so there's nothing special about money that is used as security collateral to secure these obligations. And we think we could just form that at a lower cost to a greater extent than anywhere else within traditional insurance.
Avichal, when you were talking to Karn, looking at Re at Electric, you're a VC, you audit things, you kick the tires. What got you excited about what Re is doing, what it can do?
Yeah, so maybe zooming, because VCs are very high level. So zooming out for a second, the thing that there are like two things that kind of caught my eye about this particular thing. And it's if you step back and think about what is Re, what I think the way to think about it is there's this regulated fintech business, and it's a registered Cayman Island. You have to get licenses. There's regulators. There's rules you have to follow, and then there's the on-chain piece and the smart contract piece. And so kind of from an end consumer perspective or an end customer perspective, this just looks like a reinsurance business, right? It just solves the same problem. But there are two things behind the scenes that make this work much, much better. So one is the fact that if everything runs on smart contracts, auditing and regulatory compliance become much cheaper and easier. You know where your money is, you know how to track it. There's a ledger. Everything's super clean. And a lot of fintechs are about how do you move the money around and where's the money sitting. The second is I think the stablecoin capital market piece is really, really, really interesting. I think we have this, like a lot of people have the concept of stablecoins and they're going to move money around and people want dollars. And the way we think about this is, okay, you're going to have, today you have a couple $100 billion. You're going to end up with $5 trillion of USD stablecoins on chain. And all of these people are going to say, yes, I'm so glad I have dollars now. Wouldn't it be great if I could make 4% using treasuries? And then immediately a large percentage of those people, I think 20, 30, 40, 50, maybe 80% of them will say, wait a second, I would like to make more than 4%. How do I do that? And so they'll go hunting for yield. And so the really interesting thing about stablecoins, in my opinion, is that you've created a new capital market. You're going to have $5 trillion hunting for yield, and they will want products. And so from a business perspective, yes, you have a fintech, but if you look at a lot of these fintechs, you often have a very big capital markets function because so much of the job of a fintech is going to the capital markets and raising all the time. This is why like Blackstone exists, right? They take all this debt, they tranche it, they securitize it, they sell it to the capital markets. There's pension funds on the back end. It's a whole apparatus. And what you've done is you've collapsed that whole thing now into a smart contract. And the stablecoin markets are just the capital markets now. And so I think the future architecture of fintechs looks something like what re is now, which is on the front end, it's a regulated fintech. To the end customer, it just does the same thing. It just solves the same problem. It's built on smart contracts so that the operations of the business are much more efficient from a regulatory compliance perspective. And there's AI agents and stuff built in, and Karn can talk about that. And then you have this capital markets piece, which is a huge part of what it is to run a fintech. And that is just the stablecoin markets on chain. So that architecture, I think, is what the future of fintech looks like. And I think re is the first that's actually sort of pieced it all together and is making it work.
So I think what you're saying, Avichal, correct me if I'm wrong, and then Karn, I think I want you to also hop in here, is that there's $170 billion of stablecoins on Ethereum. That number is growing. Everyone's bullish on the total supply of stablecoins. In the typical reinsurance world, providing capital to reinsurance is kind of just gatekept. It's TradFi. It's gatekept. It's not accessible to me. It's not accessible to most people on the internet. And it's kind of just like the siloed Wall Street thing where you already need to have $1 bajillion and know who to talk to. And Avichal, what you're pointing to is like, oh, there's this reinsurance business. There's actually two parts to re. We'll get into this later. There's the on-chain part, and then there's recover, which I think is what you were alluding to, Avichal, with it's just a normal reinsurance business. That part's nothing new. It's the on-chain part that's new. And so instead of going to extremely well-endowed financial institutions who have a ton of capital, who are interested in the yields that they get from reinsurance, what Karn is doing here with re is simply pointing that opening, that funnel, that access point to on-chain stablecoins. And now whoever has on-chain stablecoins can get access to the yields that reinsurance provides. And so that's the democratization thing. That's the on-chain, that's the blockchain ethos thing. Is this correct?
Yeah, that's right. So if you think about who's supplying capital to this market right now, it's pension funds, it's sovereigns, it's ultra high net worth individuals and certain family offices that want some exposure to a market that's completely uncorrelated with equities, with crypto, and the like. And what we've done is turned this into something that cuts up slivers of insurance risk and makes them tradable across all of DeFi, right? So there's secondary market trading of this completely uncorrelated, economic value stream that now exists. And so, yeah, that's a good characterization.
The thing I would add, David, I think is, so there's the customer benefit piece of this, which is, okay, now you can democratize access to all of these. So from the capital market side, the other side of the market here are the people that are purchasing the reinsurance. And if you think about a lot of fintechs, again, sort of 10,000 foot, 50,000 foot view, you can't really create or destroy risk, right? And so if you think about for lending or you think about reinsurance or insurance markets, like there are like three components to it. There's the base rate, and you're not going to beat treasury yield, right? You just can't borrow money lower than that. There is the risk that you're taking on from a customer perspective. So if you're underwriting workers' compensation or you're underwriting a 760 FICO score credit borrower on the consumer side or a 580 FICO borrower, that's just a certain percentage that gets imputed into saying like I have to lend you money at a certain rate to ultimately make this risk make sense. And then the third is the operational efficiency of the business, right? So if the business is more efficient at running the business for whatever reason, AI, crypto, stablecoins, whatever, that then gets packaged into the net yield that the borrower of that money, the recipient of that fintech's benefits, and as a product has to pay, right? So those are the three components. So you're not going to reduce as a startup, you have no control over the Fed funds rate, right? You don't have any control over the base rate. You don't really want to try to underwrite better. Like, I think that's a huge mistake that a lot of fintechs make, because they try to say, oh, here's this pocket of people and FICO isn't good enough, or like, hey, all the other people who have been doing reinsurance for 25 years are dumb. Like, we have a better way to do it. That's usually not the case. Like, usually these are pretty sophisticated market participants that have underwritten the risk correctly. So the place where you have leverage as a business to ultimately compete as a startup is to be more operationally efficient. So like from an ethos perspective, I'm going to hit the capital markets on chain is very compelling in terms of democratizing access to phenomenal yields, like 12 to 25% yields for the average consumer. They can now just participate. But from a business perspective, the thing to understand is that because you can do smart contracts, which means you can do your regulatory function much more easily and efficiently, and because you can have a capital markets function that just says, here's a smart contract, dump money into my smart contract, and now I don't have to hire a dozen people to go pitch all the pension funds all the time and pay these people $500,000 a year and yada, yada, yada. You have operational efficiency in your business. You've actually lowered the cost of running that function inside your business, which then means you can go offer a lower rate on your reinsurance to those same customers, which means you can actually eat market share, right? So ultimately, from an investor's perspective or a founder's perspective, what's compelling here is that the operational efficiency allows you to offer a product that's better, cheaper, faster. And as a result, you can eat up market share. And as a result, as a startup, you have a shot at competing. Because historically, if you wanted to go compete in these capital markets, you need to hire 15 people to scale. It's just like a really brutal exercise. And now you have an operational efficiency advantage. Like, I think that's the other piece of this that makes this, I think, the right model for fintech startups going forward.
And this sort of aligns with, I think, what we're seeing broadly. AI and modern platforms allow the firm to be smaller and operate at a higher scale, simply because every individual has just more leverage to what they can do using crypto tools, using blockchains, using stablecoins, and then also using AI to keep companies small, let them punch above their weight class. We're seeing this trend. We started this trend in crypto with things like Uniswap versus NASDAQ, 100 employees versus 10,000. And now with Hyperliquid even versus Coinbase, it's like 14 people versus another 1,000. And so I think the firm is getting smaller because of AI and these tools. And so, everything you're telling me, Avichal, makes a ton of sense. We can operate more efficiently. We can disrupt, slower moving gargantuan incumbents in the space using the modern tools. But is that like a 1,000x opportunity, or is that just like a 30% efficiency upgrade to a traditional business? Like, why is this the big thing rather than like the marginal improvement thing?
I think this is rewiring of ancient plumbing, right? So, just stepping back, fintechs, insurance companies, a big part of this is, hey, sophisticated underwriters, every risk has a price. There's a convergence to ultimately what that is, and maybe excess economics or rents kind of get stripped away over time. Part of the argument here is like, again, twofold. Production of the product cost comes down, so marginal cost of production comes down. And if you have a set of integrations or edge like we do into internet capital markets, you kind of subsume the market over time unless people can kind of competitively respond quickly. The second piece is, while underwriting converges kind of to what price, what price every risk should have, responsiveness differs between each of the market competitors, right? And so if you've got these AI workflows that take in information at the top end where the risk is originated or sold, that passes through a bunch of different intermediaries, all the way to the capital, all the way to the risk bearer. That happens at differing rates. And in places like insurance, it happens incredibly slowly, right? And so there's a future here where both like AI and on-chain capital make a step function difference to the fundamental plumbing that moves trillions of dollars. Right? So it's not a 30% improvement. It is the potential to eat an entire industry.
I think what I would add to that is specifically the market dynamics with financial products are a little bit different than, let's say, a SaaS business or a media business or some other businesses. And the reason is that like a 10 basis point improvement in something like insurance is dramatic, right? Like that is enough where you can go out compete everybody else, because the market participants themselves are often dealing with such large numbers at scale that a little bit of efficiency, like 30% is like you are like $100 billion company, right? Like you are going to crush if you're 30% more efficient as a fintech business. And it's because the market participants are thinking about numbers in very small increments, right? It's like if you can improve things by a couple of basis points, you win. Like everybody will just switch over to you. And it's also because your counterparties often are very, very rational. So, if you're talking about a business saving a little bit of money on something that they have to do every year, they're totally going to do that. Contrast that with do you really care if you're going to save $10 a month or $20 a month relative to your $100 a month Airtable subscription or your Notion subscription or your Slacks? It's just like too much work to rip it out. And so that's not why you make decisions that way. But for these financial products, lending, I think about a mortgage. Like, how do people decide where to get a mortgage? It's like, well, it's 6.3 over there and it's like 6.25 over there. I'm going to that person, right? It's like, these are tiny, tiny improvements that you have to make in sort of the net rate that somebody pays, and the entire market will flip.
So if you're right, Avichal, I think what is going to happen on the re side of things, assuming in a vacuum that the concept and theory of re is correct, that re is only a 30% efficiency upgrade in one direction, but the size of it grows very, very, very large. That if you are correct about your theory, that would be the outcome, correct?
That's right. And not only that, but I think this is what's so compelling from a startup perspective, is that if you manage to do this on the stablecoin side with the on-chain capital markets, the way that re is, I think it's going to be very difficult for the incumbents to tap into that same efficiency, right? So like everybody's going to do AI. All the fintechs are going to do it. The banks are going to try to do it. And I think on the startup side, you execute faster and you have a real shot at workflow efficiency. So every startup is going to do that. I think it's going to actually take the banks and the insurance companies and mortgage brokers and HELOCs and credit card companies. It's going to take them a long time to figure out how to tap into the on-chain capital markets. And so I actually think that's a durable advantage. So not only can you get big on the back of this, but I think you're going to be competing against incumbents that don't know how to do it at all, because they're starting from zero and they're starting actually even farther behind than they are on the AI stuff. Because they have they're like, I don't know how crypto works. I don't know how Ethereum works. I don't know how on-chain capital markets work. I'm kind of waiting for clarity to happen. There are all these sort of points of friction in compliance and tech and whatever. AI is already greenlit, right? So everybody's starting to move faster on the AI stuff. So I actually think the companies that figure out the AI piece and the on-chain stablecoin piece, the way that re has, actually have more of an advantage relative to the incumbents. And so you get big and you just start eating up the market share from the big guys, because they're not going to be able to tap into the same efficiency pools that you are. They can't. Basically, like with AI, I think there's an argument that the incumbents will be able to gain those efficiency improvements, and that OpenAI and Anthropic have these forward deployed engineering teams that they're building, because that's where all the money is. So they have to go to the big guys. They have to go to the incumbents to get the workflow optimizations, and the AI companies are going to try to make that happen as quickly as possible. And so that's a tricky place to be as a startup. Now, I think you can still obviously build huge companies there. You can move a lot faster, but there's no forward deployed engineering organization that's going into insurance companies and teaching them how to do startups, to do stablecoins right now, right? So I think this ecosystem actually has a more durable advantage because the incumbents have no idea what they're doing right now with the stablecoin markets.
And that is the bigger idea, by the way, right? So like, while I own a reinsurer and the protocol controls an on-chain, vast capital ocean, what will and is already happening, Bermuda reinsurers, Cayman reinsurers are approaching us to be able to tap that pool, right? And so it starts to behave much more like a Lloyd's of London, where you have this common capital pool that can feed any insurer and any reinsurer in the world. And that is a massive idea.
I don't know if you want to go in this direction, but I think this is like a fascinating thread to pull on, which is, you see this in a lot of markets. Like, I was an intern at Amazon right before they launched AWS, so on the software engineering side. It was really interesting because the CTO, Werner, was already talking internally about how they were going to launch these compute products because Amazon was built on all that infrastructure. And they were just going to take those things that they were using as the first customer and open them up to everybody else. And so I think the other thing that a lot of people are not fully appreciating right now is, I think there are a handful of fintechs. You're kind of seeing Ramp do this with AI. But I think there are a handful of fintechs that are figuring out that the AI workflows and the crypto workflows, like Stripe is kind of trying to do this, are actually infrastructure. And if you solve it for yourself and you really get the flywheel going, then you can go offer that as your AWS to everybody else. So I think a lot of these fintechs, if they're done well, actually end up having a second act. So the first is like, can you be a $10 billion company on the back of reinsurance or HELOCs or credit cards or whatever. And then your act two is I've solved my own problem. And so now everybody else in my industry should be running on my platform. And so like the eventual thing here, I think, is there will be these choke points that are like, hey, in Karn's case, Munich Re and Swiss Re, if you want to access the on-chain stablecoin markets, and this is a multiple trillions of dollars of capital markets sitting here at a net lower cost than you can get in other places, you got to go through our infrastructure. And now you're monetizing the whole industry. I think there will be a handful of fintechs that figure that out, per sort of industry slice, whether it's insurance, reinsurance, credit cards, HELOCs, mortgages, like whatever. I think people will start to figure that out as infrastructure as well. And I think that'll be the act two for a lot of these fintechs.
And you're saying that could be, in theory, act two for Re here. So like if we're extending the metaphor, Amazon once upon a time sold books, and now it's Amazon, and Re once upon a time sold reinsurance, and then it becomes what?
Sorry, yeah, in an internet capital market for all of insurance, right? So Lloyd's, it's
it might be worth talking through the history of Lloyd's. I think people may not even understand how interesting Lloyd's of London is as a business.
Yeah, roughly 330-year-old insurance marketplace, started in coffee houses in London. Folks who were attempting to self-insure transatlantic trade, morphed into one of the largest insurance markets in the world. They have roughly 103 distinct underwriters from around the world that bring in business. The Lloyd's market, much like the Re protocol, dictates who the acceptable counterparties are, lines of business, capital requirements, has a governance council that kind of oversees all of this, and behind it, a very large pool of capital that secures the network, for a lack of a better term. And so a ton of our own inspiration comes from Lloyd's, and that itself is, it has licenses in practically every country in the world, has laws that have been drafted that enable local insurance companies and underwriters to be able to transact on the network. That's the North Star for us.
It's really interesting. Like I'm such a huge fan of going back and reading the history of finance, because finance and capital markets are technologies to allow us to coordinate and share risk and then go pursue really big opportunities. And so, I mean, Karn, correct me if I'm wrong, but I think, like, if I say anything incorrect here, you're the expert on this. But I think if you look at Lloyd's, it looks like a DeFi protocol. Like when I first understood it, when Karn first explained it to me, I was like, holy shit, this looks like a DeFi protocol. There's like a bunch of money sitting here. There's like a governance council. People come in and sort of like pitch their idea to the capital market pool. You sort of like section off the risk. You squint at it and you're like, this looks kind of like Morpho and Aave and Silo, and you start squinting at it, you're like, holy moly, we just like reinvented Lloyd's of London on chain, right? And they just look so similar. And so for anybody who hasn't gone back and read the history of this stuff, I think reading about like the joint stock company and the Dutch East India Company and Lloyd's of London and these things that have been around for hundreds of years, you look at them and you're like, oh, we're just doing the same thing now with smart contracts. Like the structure of these things as protocols looks very, very, very similar. It rhymes. Like you can look at it and say, oh, I get why this is going to happen in a very particular way.
We don't say it too often anymore, but we used to say it quite frequently on Bankless, is we are just speedrunning the history of money and finance on chain, including human coordination. Karn, 100%. I want to learn a little bit about the reinsurance market. Just how big is this market? How much dollars change hands? What kind of metrics can you put behind the market that you are going into?
Yeah, so $1 trillion in premium globally. About
what does that mean? $1 trillion in premium? That means like $1 trillion gets paid?
Yes, correct. So premium, there's policies out in the world that are sold. In our specific case, we cover very plain vanilla low volatility stuff like auto, home, workers' comp, commercial property, the basics, very little.
Because you're getting started, right? So you're starting with the basics.
Correct. Yeah. So nothing that's super high volatility, nothing with a binary outcome that says we destroyed capital or we made a multiple of our money. Certainly, like you titrate that type of stuff in at scale, but as of right now, low volatility. So $1 trillion in reinsurance.
What I'll say about that, what's really nice about that, I think, is that it's law of large numbers, right? So you're not talking about like, oh, hurricane hit Florida or there's wildfires in California. That stuff is really hard to model and you have tremendous loss risk. But, like what are the odds that for some reason, I mean, maybe like if an asteroid hits the Earth or something, there's a bunch of workers' comp policies in Massachusetts and Florida and California that have to get paid out all at the same time. But the law of large numbers, that just doesn't happen. And so what that means is the business is really predictable. And so then as like a capital provider into those markets, you're the bounds of what you can expect are very, very well understood. Like you can run a spreadsheet model and it all
right, because once again, we are not competing on Karn and Re's ability to underwrite. We are competing on the ability to attract a large amount of capital to take advantage of the law of large numbers. So we're starting with the basics. We're starting with probably the least volatility thing ever, kind of just to like prove out the market. And like, I don't know, maybe Karn, as things get larger, you can insure more exotic things, but like we'll save that for later.
Yeah, that's right. You want to build the muscles. You want to attract the underwriters around the world that have the specialty in that particular domain, right? So if it's earthquake or if it's flood or it's fire, what you want to be is a capital source for the most sophisticated actors in the world to be able to tap this and deliver economics rather than trying to kind of build that muscle entirely yourself. Yeah, so massive reinsurance market. This sits below an even bigger insurance market. So we're talking about 7 to 8 trillion in just insurance premiums across health, life,
normal insurance,
property and casualty. Yeah, correct. And so this is the stuff that you will buy from your broker or you'll buy on the internet. And what you'll see is that even that starts to over time kind of start to converge, right? Because if you abstract everything away, all of it is kind of just supported by a massive pool of capital. And there'll start to be fuzziness around those edges. But so it's incredibly large. I think it's roughly 12% of global GDP.
12% of global GDP is
something like that.
Is the 1 trillion in premiums that are paid. That like
the entirety of the insurance market. So the 7 to 8 trillion of insurance plus the trillion.
One framework I heard at one point, so I can't take credit for it. I think it might have been. I can't remember who it was, so I don't want to misattribute it. But you can literally even think about the government as an insurance company, right? Like, what is the government ultimately doing? It's like, fire and police and the army and
provide services,
Medicare and Medicaid and the military and specifically insurance services, right? It's like just in case something terrible happens, that's the stuff the government should do. So I think there's an argument that actually it's not like 12% of GDP. It's actually like
the whole
80%.
thing.
Yeah. Because it's like all of the stuff the government actually like backstops ultimately. It's basically like the government is a giant insurance company.
Yeah. But with both guns. Yeah. It's an insurance company with guns.
Both guns. Yeah. Yeah, that's right.
Okay, just to kind of like keep on illuminating this for the listeners, because we think about finance and money a lot on Bankless, but not really insurance. So like I'm a consumer of a certain number of insurance products. I have renter's insurance, I have homeowner's insurance, I have auto insurance, and this is primary insurance. And so there's a specific insurance company that will pay me out if I get robbed or my car crashes or my house burns down or something. But you insure those people, and so you are a step further away from the risk, but you also need to be larger as a result. And so how do you get paid? How does reinsurance get paid? Complete this like flow.
Yeah. So insurance companies buy reinsurance for a variety of reasons. Like maybe they feel they're too concentrated in a particular geography or line of business. Perhaps they have faster than expected growth ambitions. Perhaps they want to diversify into a new line of business. All of that requires capital. And so they could go to market for it. There's a certain cost of capital for that. From a regulatory perspective, it tends to be advantageous to buy reinsurance because you have these other regulated counterparties that could now funnel you cash that enables those ambitions, whatever they may be. And so very likely, your home insurance policy, your auto insurance policy, or what have you, some part of it is reinsured by one of the major reinsurers, right? I almost guarantee it. And part of it's diversification. Part of it is just ultimately what's the ambition of the team that's running the insurance company and what have they convinced their board to do?
Is that just because there's somebody out there who's willing to take more risk for more yield, and then somebody out there who doesn't want that much risk and will pay someone to take that risk? And so there's you can kind of like slice up risk and yield in any different way, and that's kind of what in the insurance market does.
To some extent, I mean, like what you would be looking at as an operator is, hey, I'm in a business that involves some risk, right, and some volatility. I want some part of my economics to look much more defined and like feel like, right? And so as somebody who's running, the Bankless insurance company, you'd say, I'm much happier earning 20 or 25% for just originating the insurance policy, servicing the insurance policy, and I want to send the risk out the door, or at least in some part, so that I can dampen volatility in my earnings, right? There's a very specific purpose for reinsurance, and it is as a capital source that helps to achieve that end.
Okay, Karn, tell me, say I am a depositor of USDC or stablecoins into re. What do you do with my money that I just deposited? How does that get into the system? And what does that do?
Yeah. So as a stablecoin depositor, you'd end up in kind of one of the capital tranches that is of varying degrees of risk remoteness and liquidity. At the bottom of the capital stack is our own money, and so one of the ways we've been able to convince the DeFi market that we're a credible place to park capital is by putting our own capital at risk and eating what we cook, right? And so there's roughly 77 million in our reinsurer assets that are on underwriting risk today and act as first loss. There's a re.xyz product, which is kind of like a mezzanine layer that is relatively high yielding, less liquid, that folks can park their money into, receive a deposit token, go do things in DeFi. And then a fairly liquid senior layer called re.xyz, which is minimum doubly over collateralized, very remote from insurance risk, and is, there's all sorts of markets have popped up around this already on Morpho and Fluid, on Pendle that folks take advantage of today. And so that's a capital structure, but critical to all of this is we are the only folks in market that eat our own cooking, put our money where our mouth is, and protect the depositor capital ahead of everything else.
So when I deposit stables into re, do you guys just hold on to it, or do you guys take it into TradFi and
Yeah, so there ends up being two components to it. The kind of the beauty of the insurance business is it's not a lending business. It's like going out the door right away. A big part of our reason to exist is to prove to the world that we have the capital in case certain things happen en masse, right? And so there remains a significant amount on chain and risk-free and related assets. And then as capital is called by insurance companies, that finds its way through a transformer in the form of a regulatorily compliant note that ends up in segregated trust accounts. So it's all kind of risk-free assets. It's all bankruptcy remote and segregated, utilized by the insurance company and then returned by the insurance company. That's the basic flow.
And that only happens when somebody needs to get paid out because like something bad happened, right? I don't know if there's a technical word for this in the insurance business.
No, it's actually kind of more mechanical than that. So each of the insurance companies is regulated. They need to show solvency. Part of their solvency is showing reinsurance credit, and so there are distinct points in the year where they need to check a box that says, "Hey, capital has moved into a trust account. It is available in that trust account for any sort of adverse development." And as time passes, premium earns, risk is removed, that capital comes out the other door. That's the basic flow.
And then retakes it and puts it back on chain to provide the yields to the depositors?
Yeah,
okay.
That's right.
Okay.
One way to think about it, kind of mechanically for a reinsurance business, is like the government has certain collateralization ratios. So because the numbers are well understood here, what you can do is you can say, I will put $1 in a trust account, a segregated account, and that serves as collateral for up to $5 to $7 worth of written premium. So let me know if I misspeak on anything here, Karn. What that means is that you're essentially, right, if those people, because they're looking at these as a law of large numbers, they're like, well, I could borrow money myself at like 4%, right? Or 5%. What you have is essentially that dollar is levered, right? 5 to 7 times. And so in effect, that pool of capital can earn 5x the risk-free rate, right? So that pool of dollars, because it's underwriting $5 essentially that have been lent out, and you only have to pay a certain amount out, you're actually making like 20% on that. And so then you do have some loss ratios, you do have to pay a certain amount out, the business needs to take its cut. And so you can very quickly, back of the envelope, you can say, okay, well, if you're operating like a 5x leverage ratio here, that pool can make 20%. You take out all your fees, and now you can see why the people who are putting the money into the smart contracts that's getting offboarded into these trust accounts could make 10, 12, 14%, right? Obviously, these things are variable. There's a lot of risk, not investment advice in any form, but you can very quickly do the back of the envelope math. And now you're starting to talk about return for stablecoin holders in the teens, but in a way that you're like, wait, I understand the risk here, right? This is not like a Terra Luna situation where it's all, exogenous to crypto and it's all self-referential, and when it unwinds in a terrible way. This is like, totally uncorrelated risks, geographically uncorrelated, sector uncorrelated crypto. And I can see why if the company can make 20% on the money, why I, as a capital provider into the company, could make in the teens.
So just so I'm getting the flow, there is stables that remain on chain, and those get kind of like the on chain rate, the Athena rate, the yield rate that you get from USDC on chain, just because why not, obviously. And then Re takes some of that capital and deploys it where it needs to collateralize other insurance companies, because that's just what's required in the industry world, and to be compliant and solvent. That money is like the productive money that's like collecting the fees and earns the actual yield. So a little bit of money goes out, a lot of money comes back in the happy case, so long as no systemic thing happened that wipes out all of insurance. And so a little bit of money comes out, a lot of money comes back in, and then that gets added back into the pool and turns into the yield that the USDC depositor like me put in there in the first place.
Yeah. So just to be sure, there are exclusions for the systemic things. Those aren't a real thing in our business. But fundamentally that's it, right? So the insurance company pays us premiums. Those premiums end up being investable float, right? We layer a safety cushion over on top of this to absorb any sort of volatility. Law of large numbers says if we do this across hundreds of insurance companies, our results are very, very stable. We've got 51 active insurance treaties today. We'll get to the hundreds in short order, and so volatility continues to dampen, kind of as that happens. And then, if you zoom out a little bit, this is exactly, insurance companies and asset managers go together like peanut butter and jelly, right? Like what we're seeing is a whole bunch of premium come in at zero cost of capital that could be invested at the risk-free rate. Or if you're Berkshire Hathaway, it's invested amongst their asset management arm and generates a return that's kind of implicitly levered as a result of that, right? Berkshire has Geico and has Gen Re that generate all of this premium float, ends up being invested. Apollo has Athene. You see this kind of everywhere. But yes, investment income, kind of a levered position on risk-free rate, plus the insurance margin, because you still expect to make money on the insurance is the totality of the economics.
So then in that case, what are the vectors of success that you really have control over? Because we're not trying to improve on underwriting. We're not trying to mess with any of that. They figure that out. You're trying to just like access more and more capital. So Karn, when you wake up in the morning, what do you think about? Like what are the numbers that you want to make go up in order to make the whole startup successful?
Yeah. So look, I think the business ends up being a function of how much capital we have that we're able to deploy. And the reason for that is, as we go to market and we talk to these insurance companies, a big part of it is like, hey, they like money. They want to know that they're working with a counterparty that's more efficient, that marginal is going to cost them slightly less over time. As we talked about, the production of the product of reinsurance can happen at its lowest possible cost now because of these convergence of these technologies. So I think about TVL formation. I think about bringing in just capital, and then I think about human capital in the sense that there are these existing relationships, there are these understanding of these markets that locked in like the heads of people who have managed these multi-billion-dollar books of reinsurance business, and how do I attract them, to Re? And so that's how I spend most of my day. It's like thinking about TVL formation and who to bring onto the team to kind of continue to accelerate the top line. And so far, we're doing a pretty good job of that. $500 million in business is nothing to sneeze at. It'd be one of the very few DeFi protocols at $1 billion run rate over the course of the year.
What are the yields that you get? There are two tranches. So there's the senior tranche and the junior tranche. What are the yields that you can get? Do you know that?
Yeah. So for the senior tranche is fixed. It's 250 basis points above risk free. And then for the mezz tranche, I think it's between 800 and 850, depending on what's deployed.
Okay. So 850
above risk free or
above risk free. Yeah.
Okay. This once again, a BIP is 850 bips is 0.85% above risk free.
So 8.5%.
8.5%. Okay, that's more like it. Yeah. Okay, so if the risk free rate is something like 3 or 4% these days, is that about right?
12. Yeah.
Yeah.
Yeah, that's right. Yeah.
And so then you're getting 12. Okay.
Correct. Yeah.
So then why would I ever buy Stretch if it depegs and goes $8 off of its peg and it's only giving me 11%? And you're telling me that I can get like 12 point something %.
with all of the collateral attested to,
With all of the collateral.
in segregated trusts. Yeah.
Right. Which.
Well, David, I think you're hitting on exactly the right thing here, right? Which is like, I think the thing that has been missing for so long, but we talked about it for several years in crypto, is the productive use of capital, right? This is a capital market. You're going to take these dollars and you're going to do something useful with them in the world. And again, I would really recommend people go read the history of why things like insurance or reinsurance exist in the first place. But they unlock people, right? They unlock productive formation of capital. They let you go build a factory. They let you go build cars. They let you go do stuff in the real world. It lets a small business go run their business and be a dentist because you can have liability insurance. Like all of these like things are actually productive in the real world. And so rather than this being like some feedback loop inside a crypto based on the price of the asset, and if the asset unwinds, then your yield gets destroyed and you're in a death loop because you got to sell the asset to pay the yield. This is actually uncorrelated and it's going into the real economy where it's funding things where those businesses can make 18, 20, 30, if you have a business that's growing 40% a year because it's a real business, then yeah, you're happy to buy insurance on that business because it's growing 40% a year, right? And so that's a real productive use of capital. And so that money flowing back is, this is the glue that we always talked about, right? It's like, actually, this is, you're now having real net productivity impact in the world. And that's not fake return, that's real return. Which I think is awesome. That was always the promise of this stuff, is we're going to glue it together. It's actually finally happening. I think it's so funny too that it's happening in the bear market, because this is always what happens, right? We had all this hype about this kind of stuff 5 years ago, and then DeFi looks like it's dead, but now you can actually wire everything together end to end between regulatory being clear and the stablecoin markets being clear and smart contracts working and the fintech people having figured out how to offboard. It's like all of the infrastructure now exists to finally do the thing, but it's the depths of the bear market. So nobody's paying attention. And so by the time people figure this out, we'll be like in a raging bull again. And people will be like, oh yeah, why wasn't I paying attention 18 months ago? But I think to me, it's really amazing that all the pieces now fit and it actually works end to end. And these guys it's not theoretical. Like they're actually using the dollars from stablecoins to go do stuff in the real world with them.
Yeah. Karn, you mentioned when people come and deposit USDC, they get a receipt token representing the collateral inside of the system. Speaking of what Avichal just said about puzzle pieces fitting together, that's a puzzle piece that you are allowing to go into DeFi, and DeFi people can do DeFi things with it. The first thought for me is looping. Can I go and take that receipt token, collateralize it, get a loan on that, put more USDC into the pool and like loop up my yield position? Because like, don't you expect that to happen?
Yeah. So it's happening, right? So
Nice.
we've had a number of the top tier curators do their risk assessments on our products. Stakehouse, Chaos Labs has looked at us, and you can now, you can loop against re products on Morpho, on Fluid, and a bunch of other Borderland markets.
What kind of yields are they paying out?
So on a fully loop basis, I think it's got to be high teens, low 20s is my last check. But that
do those things make you nervous?
Separate...
Or what you've been saying is like, you give low risk insurance to very stable like outcomes. So like, I don't know, I've done pretty stupid stuff with that money. I don't think like kicking the tires just with you guys right now, that doesn't seem like the stupidest.
Yeah. So from my perspective, right, I think what we care about is making sure that we take in the capital, we show the world that, hey, on a risk adjusted basis, this is a great place to park stablecoin capital. We have less to say on what people decide to do in broader DeFi, right? A kind of their own volition. That's to everyone's own kind of risk,
it's outside
taste,
of
and
your
tolerance.
purview.
And honestly, not giving financial advice in any regard, but the infrastructure is all there.
But you're stoked about it because any growth in the looping product ends up with just more stablecoins inside of your product, which is what you want in the first place.
Yeah,
which is what Avichal is saying with like, look at these capital markets that are available. This is what that looks like.
That's right. Yeah. It makes the product and offering more compelling, and it helps capital formation for sure.
By the way, this happens in TradFi too, right? So this notion of looping, as we call it in DeFi, it's like this is like the financial people have all figured this out, right? It's like, hey, I got some relationship with a pension fund. They're letting me borrow at 4%, and like these guys are giving me 12. And like if I just like stack that a few times, I'm just arbing the spread. And I'm taking some risk that thing, like, if the risk is greater than I thought, then like I eat in my own margins, but like, leverage and what we call looping, which is like borrowing from one place at some rate to go invest it into some other place that has a higher rate and capturing that spread. That's what finance is all about, right? And then the question is, can you find capital providers that will continue to lend you at that rate? So yeah, I don't think there's like anything untoward about it, as long as people understand the risk that they're taking and people understand, when and when they can't get, incur losses in that sort of scenario.
Right. Karn, the re token is coming, or is here today, because that's why we are recording this podcast and releasing it today. What is the re token? What does it do? How does it function in the system?
Yeah, so it's a governance token for the re ecosystem. It's intended, as we discussed, kind of emulate Lloyd's of London governance. So it dictates who the acceptable counterparties are, lines of business, what capital is required, and it governs, importantly, the common pool of capital, the size of that capital when it gets released, the economics that accrue to the network kind of over time. And so that's the goal. The beauty of all of this is that we're not inventing anything new. This is like 330 years of evolution in the insurance market that's found its way on chain as a starting point.
So Lloyd's of London, it was the model of this token, as you said. What's the incentive to govern? Why would I govern? Why would I care?
Yeah. I mean, it has the potential to be an enormous sum of money that protects tens of millions of people around the world, and that has an investment policy. That access is valuable. Where it's pointed to is valuable. Every asset manager and every reinsurer insurance company in the world should be interested in this, right? If we are in a position to be putting tens of billions and whatever the secular trend of the stablecoin market is into a pot that is now accessible to this broad market, it becomes a really high leverage tool for folks to be holders of the governance token.
Mm-hmm. Right. So if you have a lot of the governance token, you can allocate the capital of the system towards certain endpoints. You, as a large holder of the token, have some sort of like internal alignment with it, because if you choose poorly, if you are corrupt, then you're invalidating the value of the tokens that you hold, and clearly you hold a lot, because that's why you have the power and influence in the first place. Karn, this has been just like the broad concept of like governance tokens in DeFi and the philosophy about why they are valuable in the first place. Most of them have not worked that way. Just if you look at the price on the market, and there's been sometimes the product themselves didn't follow through. Sometimes the product did follow through, but the token was a governance token that didn't capture value. Why will this one be any different?
There's a real business with massive cash flows behind it, right? And so if you think about a central fund analogous to Lloyd's, the economics that it accrues, the economic disbursement or accumulation to protect the network and to protect insurance companies, there is a sum of economics and cash flows that can perform multitude of economic actions that show value here. So I think what you're asking about is like governance and the distinction between value accrual. I think it is super valuable to potentially be controlling the largest insurance capital pool on earth over time, right? And the knobs and parameters that dictate kind of how it moves.
Cool. Karn, when we log off of this podcast here in a second, what are you going to go do back at Re? What do you need to go get your fingers dirty with? What's on the near term roadmap? What are you trying to get done like this quarter and this year?
Yeah, it's TGE is a trying experience. I'm glad that we're kind of past it. We have a real business to run. We're running at adding a couple $100 million more new business over the course of the next couple of months. And then we're gearing up for Jan 1st, 2027, which is when the insurance market kind of turns over and renews to crack $1 billion in premium. And so we're no longer, a toy. We're no longer kind of conceptually interesting. It is a real market player with real market access and capital to boot.
Mm-hmm. Avichal, this is a question for you actually. There's a lot of degens on chain. In fact, it's kind of one of the few players that are left. It's like basically degens in Wall Street building in crypto. Are all of the relevant parties that are interested in what RE is offering, the yields, the 12, 14% yields, the reinsurance yields, are they on chain? Like, do we even, like we talk about the stablecoin capital market, sure, that it totally exists. But I don't know if the parties that RE is interested in collecting their capital to are on chain yet. Am I wrong in that, or is there more people to bring on chain for the future of RE's growth?
I think there are a lot of people still to come on chain. I mean, I think the entire insurance industry ultimately, needs to be here tapping into these capital markets. Again, if we go to this future world several years from now where there's $5 or $10 trillion of stablecoins sloshing around, and it's just because it's the most efficient way to custody and move these assets and track where they are, that the entire financial world should move here. Then a bunch of that will want to seek yield, and a bunch of that will find its way to these pools. And so, the on-chain capital markets, I think there will come a day, like 20 years ago, let's say 25 years ago, let's say circa the year 2000, right? There was this notion of going online. And so you'd say like, oh, I'm offline. Mm-hmm. And I think on-chain is kind of like that, where people talk about on-chain capital today, or we talk about stablecoins. And I think there will come a day somewhere in the next decade where we just stop using that term. Like, you can't be offline today. There's no notion of being online or offline. It's just like, well, it just kind of merged. It just became the same thing, right? I think the same thing happens with on-chain versus off-chain. And so when we hit 5 trillion, it's not going to be on-chain capital markets. It's just capital markets at that point, right? And they just kind of blend together. So there's a long way to go to get all of those market participants that need to be around for around the table for that to actually happen. And I do think that happens over the next 5 years. Now, what's interesting is we've always thought about that, right? We've been talking about, like, our thesis at Electric back in 2018 when we started was this notion of programmable money. We've always said that that's going to happen. I think the thing that, and by the way, we can't take credit for that term. I think that term has been in the ether for a while, no pun intended. But that was like our thesis paper that we wrote that said, why should we even do this? And I think the thing that the builders did was they created all of the supply. Like, we created protocols, we created looping mechanisms, we created, Morpho and Aave, and we got Gauntlet and Stakehouse. We got all these components that are like, hey, I'm ready to go. And the thing that was missing was the demand. And it's like, well, why is somebody going to bring their stable coins in here? Why is somebody going to do asset management on chain? Like, why is that going to happen? And the thing that we needed was that last mile was, I need to be able to take these assets and get productive yield from them. I need to be able to do something useful with them so that the person who is holding this token or is putting the capital at risk knows that what they're getting is 6, 8, 10, 12, 14, 18, whatever percent. And I think that is what's starting to happen now. So I actually think, like, a lot of the plumbing exists, like you're talking about the looping. The plumbing is in place to make the flywheels work. The last thing that we needed was the demand side, right? It's like, why do the stablecoin holders want to do this? Why do they want to put it into the plumbing in the first place? And it's to get yield. And now we can actually get productive yield. And so that, I think, gets the flywheel going. And then once the flywheel is going, then the bigger capital providers just look down chain and they're like, well, that's where I should be. That's where the money is. That's where the efficiency is. And so then the whole thing starts to, at least that's our bet, right? I think that's probably what the next 5 to 7 years look like, because now that the demand is all plugged in, the flywheel starts to work, the loops start to work, the capital providers on chain start to work, and then the big guys start paying attention and have to move on chain.
Mm-hmm. Karn, the name of the podcast is Bankless. We started it, back in 2020 with the idea of, like, taking control of one's money, because why would I put my money in a bank that's giving me 0.04% yearly yield? And they get to go do exactly what Avichal is saying, make it go productive, but they get all the productivity out of it. We get none of it. So what are we doing? Giving them the finger, and we're going on chain. There has been a number of products integrated into Coinbase that have kind of been of the DeFi mullet thesis. Fintech in the front, DeFi in the back. We got Morpho's in there giving Bitcoin loans. Athena's in there now giving yield. Could you see RE being like the new savings account? Is that an appropriate way to illustrate the product? Is that not responsible in the same way some people are critiquing Sailor, calling Stretch a savings account? Like, do you see the DeFi mullet thesis kind of playing out for just being a funnel for capital for RE?
Yes, I mean, certainly, like the current state, we are a DeFi mullet, right? We run a traditional reinsurance business on the front end. We've got the machinery on the back end that is abstracted away, mm-hmm. but elegant, and people will want to access. If you think about what reinsurers and insurance companies become in the limit, they become the largest asset managers in the world, right? And so there is a pathway here to something that's a little bit more diversified. I won't profess to having designs on that right now because I think there's tons to do in reinsurance and insurance generally speaking. But as soon as you get, you have entities that are writing hundreds of billions in premium, there are natural segues and there are natural paths into other parts of finance.
Mm-hmm. Avichal, Karn, thanks for coming on the show today and teaching me all about reinsurance and re, and good luck with the TGE. And I hope you guys cross $1 billion sooner rather than later.
Thanks, man. Appreciate the time.
Good to see you.
Here's guys. Bankless Nation, you guys know the deal. Crypto is risky. You can lose what you put in. Insurance is also risky as well. That's kind of the whole point. But nonetheless, it's the frontier. It's not for everyone, but we're glad you're with us on the Bankless journey. Thanks a lot.